Does your business always feel like it's about to run out of money, even though it's profitable and even though it's growing? I've worked with many brands that grow and are profitable, but they always feel like they're about to run out of money. They're always strapped for cash. Why is that? I can tell you now, it's almost certainly tied up in your working capital. Today we're going to break down working capital. I'm going to give you the one number that you need to manage your working capital and turn it into cash with all other things remaining equal. Okay, working capital, what is it? You've heard that many times. You probably said, yes, you know what it is. But do you really know what it is? Let's get into it. Working capital is your current assets less your current liabilities. That's on your balance sheet. Current assets less current liabilities. But for this calculation, that's too general because there's lots of other things in current assets and there's lots of other things in current liabilities, which will get in the way of the calculation that we really want to get to. Here's how we want to look at our working capital. Inventory plus receivables less payables. But let's not move on too quickly. Let's dig in here. Inventory is kind of the obvious one because you know that you invest in your inventory, you see it in your warehouse, and you know you need to sell it through as quickly as you can. Where it gets interesting are the other two, the receivables and the payables. And I want you to think of them like this. Let's say you've got a customer who's a big box retailer. They have terms of 45 days. So that means you ship your inventory to them and they only pay you in 45 days. So what's happening? You are lending them money for 45 days. You have given them your inventory. You have not got the cash. They've got the cash and the inventory. You have what is essentially a loan, but we're going to call that receivables. That's what you have. And on the flip side, when your suppliers give you terms, they are lending us money. So for that part of the calculation, we want to deduct payables. So we're going to take our inventory, we're going to add receivables, and we're going to deduct payables. But this is not the number I promised you earlier. What we now want to do is take this formula and we want to break it down into days so that we have a timeline. And this timeline is going to be called our cash conversion cycle. And this is going to tell us how long it takes for our business cycle in cash terms to do one full rotation. Inventory is purchased. It is paid for, clock starts ticking. We sell the inventory, we would collect the cash, clock stops ticking. What is that number in days? When you've calculated this number, you're going to be blown away by how long it is. But firstly, how do we calculate it? How do we turn this formula into a timeline in days? Days of inventory. First thing we need to know is what is our average sales per day. Then we've got to calculate what is our average cost of sales per day, because that's the number we really want because inventory is not marked up. Inventory is at cost. So we have to figure out what is our average cost of sales for our product every day. Then we divide that number into the inventory. It's going to give us a number of days. It's probably going to be about 90 days. But the shorter that number is, the better for your cash flow because it means you're selling your inventory quicker on quicker turns. The next number is your days sales outstanding. So here we're going to take our receivables. We're going to divide by our average daily sales, and that's going to give us a number, which is probably going to be very similar to the terms that we give to our customers. But don't use just those terms numbers because not all customers are going to pay on the terms that they were given. Use the calculation. Now for our days payable outstanding, we're going to take our average daily COGS, same number that we used when we were calculating our inventory, but this time we're going to divide it into our payables. This will give us the amount of time that on average it takes us to pay our suppliers. Again, you're going to have a whole lot of suppliers. They're all going to have potentially different credit terms. So we just want to get this blended average rate. And that's how we're going to calculate it. So now that we've got these days, we're still going to apply the same formula. So we'll take our inventory days, we'll add our receivable days, and we'll deduct our payable days. And this is our cash conversion cycle. Now to illustrate the point, here we have a cash conversion cycle of a pretty normal business which receives inventory. 30 days later they have to pay for their inventory. Meantime, they're trying to sell their inventory as fast as they can. And in this case, we're assuming that it takes 90 days for them to sell down their inventory. We're also assuming they're giving their customers 30 days to pay. So applying this to the formula, we have the 90 days for our inventory days. We add our days sales outstanding, 30 days, and we deduct the days we get from our suppliers. So this leaves us with a cash conversion cycle of 90 days. Now, if you are a relatively new company, there's an added wrinkle. You probably do not get terms from your suppliers. Your suppliers probably want you to pay some amount upfront before they even start the manufacturing, and then they want you to pay in full before they even release the product. So here you're paying your suppliers before you even receive the inventory. So now you're going to have a negative number for your payable days, which means you are lending money to your suppliers and to your customers. You're lending money at both ends of the spectrum, and you have inventory caught in the middle. This is where all your cash is going. So applying this formula in the same way as we did before, you've got your inventory days of 90. So those are the number of days it takes you to sell through your inventory. You've got your days sales outstanding of 30 days. And then you've got a negative number for your days payable. So a negative and a negative is a positive. So if you take 90 plus 30 less minus 10, you end up with 130 days. That is your cash conversion cycle for a small business which is fronting up to pay for inventory before it's even been received. Now here we have the holy grail of working capital management. This is where you want to be. But to get here, you have to have power with your suppliers and you have to have power with your customers. And only big companies can do that, like Amazon and Apple are famous for their working capital management. They have negative working capital. Let me show you how this works. You receive the inventory on day 0. You have 45 days to pay. But by day 30, you've already sold all that inventory and you've been paid 5 days later by your customers. So you actually have received the inventory, sold it, and been paid for it, and you still haven't paid for it yourself. In this example, our days sales of inventory was only 30 days. Our days sales outstanding was only 5 days, and then our days payable outstanding was 45 days. So we actually ended up with a minus 10 on our cash conversion cycle. So what this means is our customers and our suppliers are funding our business. This is the holy grail. This is where we want to be. But if you're a small to medium-sized business, it's probably not going to be easy to get here, but you can shrink your cash conversion cycle. Now, this week's homework is to calculate the cash conversion cycle for your business using the same formula that we did today. When you come up with that number, please put it in the comments. Also, please tell me what type of business you're in, what industry you're in, and give me a general sense for the size of your business. You don't have to be exact, just a general sense of the size of the business. And then we can start looking at ways to improve your cash conversion cycle. And by doing so, you will end up squeezing out cash from your working capital, with all other things remaining equal. Next week, we're going to look at the 3 levers to pull to make that cash conversion cycle shorter. In the meantime, hit subscribe, follow the channel if you like this kind of information.